Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is October 18th. Today we're going to take a look at Walgreens Boots Alliance. This is out of the healthcare sector. Let's jump right in. So if you want to know more about this company, check them out at www.walgreensbootsalliance.com. That's www.walgreensbootsalliance.com. That is their homepage where I pulled this information from. As you can see here, 1849, John Boot opens first Boots store selling herbal remedies in Goosegate, Nottingham, UK. So this is a British company, or started out as a British company. 1870, the Boots business begins to develop under Jesse Boot, John Boot's son. So that is where they got their roots from, right? Way back in the day. Now, Walgreens comes along a little bit later, but Walgreens acquired a 45% stake in Alliance Boots, taking the first steps in the strategic partnership to create the first global pharmacy-led health and well-being enterprise in 2012. It took them several years to kind of complete I wouldn't call it a takeover, but the acquisition or the combination of Walgreens and Boots Alliance. And again, Walgreens you're probably familiar with if you're here in America. They're similar to CVS, right? A pharmaceutical company on a lot of corners, just like CVS is. Walgreens and Alliance Boots form Walgreens Boots Alliance Development Joint Venture in Bern, Switzerland. So they have their hands here not only in America, but around the globe. So that is good to see. Now, I went back into 2021, so a couple years back now. In October, WBA announced its new consumer-centric healthcare strategy to drive sustainable, long-term profitable growth. The strategy features the launch of the company's Walgreens Health Business segment, now known as U.S. Healthcare, enabled by investments in Village MD, CareCentrix, and Shield Health Solutions, Shields, accelerating the company's capabilities in primary care, post-acute care, and home care. So they are branching not just the pharmaceutical side into, it looks like, kind of similar to what CVS has done, into the healthcare insurance, it looks like. You'd really want to do a lot of investigation on this one, because when I looked on their webpage here, you could see through 2021, through 2022, and even into 2023, the year we're in now, they were doing a lot of acquisitions. So there have been a buttload of acquisitions here over the last couple years that is part of this drive to sustainable, long-term, profitable growth that they are going through. Whether that is going to work out is yet to be seen, but they are spending a lot of capital on that. So let's continue to go through this here and see if this one is presenting any value. Again, www.walgreensbootsalliance.com. That is their homepage if you want to know more about them, and it goes more into the history of both Boots Alliance as well as Walgreens if you're interested in that. Now, the reason we are taking a look at them today, down 7%, huge drop on the day. This would be a big drop for a full year. Anytime I see a company drop this much on a day, I'm going to take a look at it and see if it's presenting any value for you out there who may be watching the channel. We are talking about Walgreens Boots Alliance, ticker WBA, out of the healthcare sector. Closed out the day at $21.25. 52-week range as low as $20.58, as high as $42.29. So they are closer to their 52-week low than they are their 52-week high. Average volume of 11.5 million here. Today was 16.9, and it was just a slide down the hill here from start to finish pretty much. Market cap of 18.358 billion, a beta of 0.79, so they are less volatile than the overall market. Now here's where we start to get into some issues. Price to earnings ratio, they don't show one. That is not a good sign. That means that they are most likely in the negative. Their price to earnings is not even a positive number. May have a lot to do with the acquisitions. It may have a lot to do with them spending a lot of capital right now with these newer acquisitions, not knowing where it's at, but that is not a good sign. Anytime you see this, another one that is not a good sign, earnings per share is negative $3.84 per share. So they are burning cash. They are in the negative, again, doing a lot of acquisitions. That may account for some of it. You'd want to really get into these acquisitions and see what they think the turnaround is going to be on this. How long are they expecting to be burning cash? That's really yet to be seen, but this is not good. These are not good numbers so far. earnings date between January 3rd and January 8th in 2024. So the next one will be first part of next year. Forward dividend is $1.92 paid out on the year. They are quarterly payers, so divide by 4. We'll see that here in a minute. Very high dividend yield on this, 8.4%. Right now, I'll be honest with you, I do not think that is sustainable based on what I'm seeing in the numbers, but let's keep on going through this. Ex-dividend date was August 18th. They paid out September 12th, so you would be in line for the next dividend if you were to buy them now. And according to Yahoo Finance, they have a one-year target estimate of $27.85, so they do see some upside appreciation in the stock price here on this one. Now, I like to get into statistics, look at dividend yield theory to see if there is potential undervaluation here. To do that, we go down to dividends and splits. We look at their 5-year dividend yield average of 4.27. We compare it to their current 8.4. Over here, forward annual dividend yield, 8.4%. So this is much higher, almost twice as high. So definitely speaks to some potential undervaluation, at least according to dividend yield theory. But again, lots of acquisitions, spending a lot of cash. EPS in the negative, price to earnings ratio not even showing up, so their earnings is in the negative as well. So I don't know that this is a sustainable dividend yield, but you never know. Now, I also am questioning their payout ratio here. They're saying it's 38.17%, but you will see here in another site that we look at here on this channel, they don't list it, which tells me this is not accurate. So if anyone has another payout ratio that they can reference, go ahead and drop it in the comment section down below. But I do not believe that they are at a 38.17% payout ratio from their free cash flow with the dividend yield this high. I just don't buy it. Now we're going to look at under financials. You can find a lot of information. You get in there and look at their income statement, their debt to equity ratios. Are they paying down debt? Or, are they their assets over liabilities? Like I said, a lot of good information in this one here. Their debt is a bit elevated. I did take a little bit of time and look at that, so you're going to want to look at that as well. Again, you really want to get into the financials of this one and see what's going on here. I don't cover that. I don't do that big of a deep dive, but if you are interested in this one, I really suggest you do it on this company. Now we're going to look at free cash flow. Dividends are paid out of free cash flow. We want growing free cash flow over time because they can do several things with free cash flow. Pay dividends, which is what we like. So they want growing free cash flow. So your dividends are growing. Make acquisitions. This company is making acquisitions. They can pay down debt. They really are not paying down debt. It looks like they're actually taking on some debt currently. Those are the type of things you can do with free cash flow. But 2020, they were sitting at $4.1 billion. 2021, $4.177 billion, so a little bit of a jump up there in 2021. Big drop in 2022 down to $2.1 billion, and an even bigger drop they are actually so far to date in 2023 in the negative. This is why I say I do not buy that their payout ratio is 38.17%. If their free cash flow is negative, no way that's the case here, right? So that's just common sense. They are repurchasing shares, right? A big tranche in 2020, slowed it down a bit in 2021, picked it back up a little bit in 2022, still continuing to buy back. Now, the repurchase of shares does not account for the drop from 2021 to 2022, and it certainly does not account for the drop from 2022 to current. And I would question why they're repurchasing shares at all when they should be, what it looks like they should be paying down some debt. They do have pretty high debt load, at least from what I looked at briefly when I was putting this video together. Now, I always recommend more than one source, so another one that I like is stockanalysis.com. I am not affiliated. Yahoo Finance was the previous page. That's where we're looking at there. I'm not affiliated with that one either. Just make sure you're picking more than one source so you can back check the information you are getting is accurate and that it is up to date. So according to stockanalysis.com, and the 12 stock analysts they've had to take a look at this, they call it a consensus hold. Now, I would definitely agree it's a hold. If you own it, I would not be adding. I might wait to see how things shake out. If you're looking to buy it, I wouldn't be doing it right now. That's just my opinion. And to be honest with you, this one, for me, if I owned it, would probably be on the selling block. But that's just, again, my opinion. Now, they have a low estimate of $25. It currently sits lower than their lowest estimate, so that means if it came back up to their lowest estimate of $25, that would be a 17.65% increase in the stock price. And if they hit their average of $32 per share, that would be a 50.59% increase in the stock price. And if it happened to hit their high of $45, that would be a 111.76% increase in the stock price. And again, a lot of acquisitions over the last several years. So if some of those companies are really going to help them turn around, maybe some of these estimates are accurate. maybe the numbers just look jumbled and look funky because of those acquisitions. You really, really want to do some deep dives onto these acquisitions and into their books on this one if you're interested. Now, I'd like to look at statistics on this one for return on equity and return on invested capital. See how efficient they are at using their money. And not good here either. I like 10% or better in the negative. Return on equity, negative 14.9%. Again, they are burning cash, right? And maybe some of this is accounted for them buying up and acquiring some of these businesses, but this is not good. Return on invested capital, negative 6.7%. Not good. Return on assets, negative 3.2. And I don't even really cover that one on this channel really, but none of these are good numbers. That is not good to have a negative. Even if you're making acquisitions, you want positive return on your money. Maybe they haven't had them long enough to see that yet, and maybe they turn around in the future. But right now, it's just not good. EPS forecasted growth is 4.36%. I like 5% or better, so it's under that metric there. And if they're negative EPS growth currently, I would want much higher EPS growth to bring us out of the negative, because at this rate, if this is accurate over the next 5 years, they'd still be in the negative 5 years from now, in my opinion. Revenue growth forecast is at 5.75%. That's just a bonus, so they do see revenue continuing to increase. Again, maybe some of those acquisitions they've made recently help bring them out of the negative, but so far, this is a stay away for me. It's not in my portfolio. When I was looking at companies out of this sector to add, I compared this to CVS. CVS was the choice I went with, and a lot of the reason was because of all these negative numbers. I just don't like seeing, negative 14.9% return on equity and negative 6.7% on return on invested capital, negative in free cash flow. Just way too many negatives for me. Now, I did pull up their dividend history going back to 2020. Again, see payout ratio, NA, that tells me it's negative. And their dividend growth, only 0.39%. I don't even know why they're growing their dividend right now. It's very high. I would expect if they continue in the negative with free cash flow that they are going to have to do something, probably cut that dividend down. If it's 8%, even if they cut it in half, that would still give you a 4% dividend yield and probably help them in the long run. But they're still growing at 0.39%, so it's not a zero, but maybe it should be. 2020, August 18th, they were at 0.46 and some fractions of a penny. 2021, they jumped it up to 47 cents. In 2022, they jumped it up August 18th to 48 cents. And they did not jump it up this August. So if they are going to raise it again, they would need to do it in December. So maybe they are going to pause the dividend at least, or cut it. If they paused it, that would probably be wise in my opinion, but they do pay out on the March, June, September, December timeframe. So again, if they don't raise it in December, then this dividend growth, as small as it is, will be paused. Now, this is the vested interest stock screener. This is how I set up the videos, as well as how I look at a company on a high level. If it meets 5 of 8, I put it in the pile where it's potentially investable. Then I do more of a deep dive, do a discounted cash flow analysis on it to see what I'm willing to pay, and then potentially buy it from there. Or if it's a financial company like a bank, it must meet 6 of 9 to make it into the potentially investable pile. Well, that is it for this one. That is Walgreens Boots Alliance. Is it in your portfolio? Are you buying it? Very high dividend yield on this one. It's one that personally I am avoiding. Like I said, when I looked at this and CVS and compared the two, I went with CVS. Personally, that was just my preference. Let me know if you are investing in this one. Let me know what you think about it down below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Hit that subscribe button. Join us here on this journey to financial freedom. Join the vested interest community, building a community of like-minded dividend growth investors so we can share our experiences, share stocks like this that we may be investing in, that we may be avoiding, tips and tricks that we've learned along the way as investors. We can't benefit from each other's investing, but we can benefit from each other's investing knowledge, right? It's all about sharing that knowledge and helping each other out along the way on this journey. That's what this channel is about. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a stock or company that you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below and I'll work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion in investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount comfortable losing. Always do your own research, invest based on your situation, circumstances, and selected criteria, or seek the advice counsel or a certified financial advisor.